Gold prices are much lower on Friday as a better than expected jobs report has sent traders to the sidelines and put more selling into the market. Here to talk about it is James Altucher. James, great to have you with us.
I'm glad to be here. This is the first time I'm on a Street.com video in about 4 years, so this is good.
So what do you make of it?
Well, the jobs report kind of sends two signals to the market, one bad, one good, and traders today are choosing the good quite correctly. So the first signal it sends is that, oh, the Federal Reserve might stop easing. They might start tightening on interest rates, and that's kind of a scary thing that traders are usually afraid of. But if you look historically, whenever the Fed has started tightening, the stock market has gone up, and I'm talking about 100% of the time this has happened. So a classic example is 1999. The Fed started tightening on interest rates in spring 1999, and what happened? Well, you can say the dot-com bust happened, but that didn't happen until a year later. The Nasdaq actually went up almost 100% between the time the Fed started tightening and the time that the dot-com bust happened. And if you look at just the index of value stocks, the index of value stocks never had a down year, even during the market down years of 2000 through 2002. So in general, more jobs means a strengthening economy, means stocks are doing well, means company profits are going to be higher. So why would you invest in a hunk of rock when you can invest in a growing company that is a global company that's going to be hiring more employees because of great profits and great demand? So the stock market becomes a very good investment at that point. Now, I have no prediction on the price of gold. I never predict the price of a rock, but I can predict that the stock market will continue as it has been, reaching new all-time highs.
So James, we also saw the ECB come out on Thursday with some forward guidance, which is unprecedented for them. They did say that they weren't looking to raise interest rates anytime soon, and that they would keep interest rates in the Eurozone at the current rate, and maybe even possibly lower in the future. What do you think about those comments as it pertains to precious metals, gold, and the markets?
Sure. So let's take a look at what happened we'll do the 2 minute the 10-second lesson on what happened with the ECB. So the U.S. stock market fell apart, and Bernanke started printing money to accelerate the market, whether correctly or incorrectly, who knows. He basically wrote the playbook for how the ECB should handle massive stock market corrections. The ECB has been following his playbook, but they're 1 year behind. So even if Bernanke starts to tighten, ECB has no intention of tightening for at least a year after Bernanke starts to tighten. Notice what they're saying is what Bernanke said exactly a year ago. So they're always going to be 1 year behind. And again, that's only going to mean we should be buying stocks in the Eurozone, particularly like in the strong countries like Germany or England or wherever. But again, I wouldn't look for gold as the answer in the ECB either.
All right, James Altucher, it's always great to be able to talk to you. Thanks so much.
Yeah, thank you.
For The Street, I'm Deaux.